Okay, let's do some Q&A from the last market outlook. Fiscal repression is your thesis. Lower rates by the Fed and higher debt by national, state, municipal governments sounds like a steeper yield curve to me as the market reacts. Well, yeah, it can be seen as a steeper yield curve. Well, first of all, yes, it will be a steeper yield curve. There are your money market rates, and here's your capital market. We have an inversion now. You lower rates here, you'll get lower money market rates, and you'll get a capital market curve that looks like this. You get lower rates all across the curve, but the 3-month to the 10-year will be positive as opposed to being negative. So yeah, it's a steeper yield curve. It doesn't say much to say a steeper yield curve, but yeah, that is what you will end up with. Maybe what you were trying to say is that we would get a bear steepener here, and it would look something like this. I don't think so. If we look at the action in TLT on Friday and Monday, you had big drops down on 2 days. Tuesday, you sort of had a little sideways movement like that. Wednesday, everything seems to be just fine, and the dollar is weak. I think what is going on is as you get the election over here, as you get each day closer to the election, and it becomes clearer and clearer that it is going to be a Trump victory, the Trump trade will begin to show up. What does he want? He wants lower interest rates. So he wants interest rates to drop, and he wants a lower US dollar. Yellen is gone. You can count on that. She's just going to be out of there, and he's going to replace, put a Treasury Secretary that is going to do his bidding. Powell has a choice: fall in line or be replaced. Period. That's just how it's going to be. You're going to get lower rates, and if Powell won't do it, he'll replace Powell. I seem to think Powell will fall in line like he did in 2019 and probably begin to lower rates in anticipation of a Trump victory and signal that more rate cuts are coming. Otherwise, he will be replaced. Something in PCE did jumpstart that long end sell-off since it happened at that time. Noticed PCE inflation expectation numbers are more headlined off the median. But if you look at the mean number, it's actually substantially higher. So the mean can be misleading, especially when it comes to things like expectations, right? Unless you're actually looking at real things. And even then, the mean can be misleading. So let me give you an example where the mean could be misleading. Is we say, and we'll do something simple. Let's say we have a jar full of jelly beans, and we're trying to guess how many jelly beans are in the jar, and there are 10 people guessing, and 9 are making a rational guess. The 10th one says there's 1 trillion. The mean will be significantly higher than the median, significantly higher if you're just relying on people's estimates. Let's say that you're measuring something you can actually count, which is, let's say, wealth, and how much money somebody has. You have 10 people in a room, 9 are fairly average, and you have Warren Buffett. Well, the mean will be pulled significantly higher, such that we would conclude that everyone in that room is a billionaire, a multi-billionaire. Because of the existence of that one person. So be careful about the mean, because you get one outlier and that mean can be dragged. So that's why the median is looked at. Could you please do a video on how to keep track of news effectively? Sources, what to do, deep dive in, things that you should brush through every single day, some good newsletters you follow, things like that. Don't really follow. Actually, that's not true. I do follow some newsletters, but they come from usually industry groups. So Cox Automotive, for example, puts out a newsletter. Experian puts out a newsletter. Splash puts out a newsletter if you're looking for to be kept up to date about news in the shipping industry. Every industry has its own. It's hard to know which ones to list because there are literally thousands of news sources. The company itself is a source of news. Any company you're following, you can sign up for notifications every time it releases anything. And then, of course, you have the bigger publications like Barron's, Wall Street Journals, things like that. The Apple News feed, I think, is fairly good. The more you click on, business stories, stock market stories, financial market stories, the more you'll get those sorts of things. To the point where every day you're getting hundreds of different headlines that you can scroll through and see what interests you. And then there's the economic calendar as well. So, there's no shortage of places for news stories, but you can't read it all. You simply cannot read it all. If you've got 20 sites on YouTube that are bookmarked, you got 15 publications that you read, 20 newsletters that you get, 30 companies that you follow, I'll tell you right now, you cannot read it all. You have got to be selective. And you've got to be able to scan very quickly. I rarely read every word in every story. I rarely do. I usually skip the first couple of paragraphs of almost every story because it's intro stuff I don't care about. I scan paragraphs. I look for things that catch my attention, but there's just no time to read everything. Anything I listen to at 1.5 times speed, if not faster. So I don't know if there's a video that I could make to effectively track news other than say, you have to curate your own news feed. Understanding, of course, you cannot read everything. As much as you want to know about everything, you're just not going to. You're going to learn new things every single day, but you need to focus on one particular area where you say, this is really what I'm going to focus on. And you'll find the industry sources with just, reading 10Ks. And over time, you'll just curate sources of information in your particular sub-industry. Economists from the IMF and Northwestern University published a paper arguing that the recent bout of inflation in the US and Europe was demand-driven, not supply-driven. Yeah, you can make that argument. Let me show you how easy it is to make that argument, and then you tell me which is correct. You have a market in equilibrium, demand, supply. There you go. And demand increases to 120. Clearly that is demand-driven inflation, right? Because demand is now greater than supply. Let's do it the other way. Supply drops to 80. Clearly demand is greater than supply. You can make the case that there is too much demand for the supply. You can always make the case that inflation is demand driven. Supply dropped by 80. Demand should drop to get to equilibrium. If it doesn't, if demand just doesn't drop to get to equilibrium, it will create inflation. So you can always make the argument that everything you see is demand driven, because if demand is not responding to the change in supply, then you're going to have price increases because demand is greater than supply. But let's be clear, right? In the first case, demand increased. In the second case, supply dropped. So depending on how you're measuring demand and supply imbalances, you might conclude that, well, demand is greater than supply, it is demand driven. For example, automobiles in 2022, you had less than 14 million. At one point, I think the run rate was 12.8 million. That's recession levels. But prices were going up. So that means demand was greater than supply. And if you're running recession level car sales and prices going up, there must be a problem with supply. There must be a problem with supply, period. So yeah, I would be careful on how they define what is supply and what is demand. It's not the conclusion that I would be reading. It would be the methodology and how they define things, because you can always make the conclusion whenever you see prices go up that demand must be greater than supply, and it usually is. Demand is greater than supply, but did supply shrink? We clearly know supply shrunk, right? The other way of looking at it is there is some merit to saying, when the economy shut down, services were offline, but goods could still be ordered online. So people who received money have a high propensity to spend it. It is almost an addiction. They have to spend it. Couldn't spend it on services. They directed everything to goods, and that really pushed up the price of goods, creating that inflation. So you could say that, yeah, that was demand driven there. But it was supply driven in the sense that you took a certain amount of supply off the market and concentrated spending on what was left. So demand was greater than supply in the goods sector, but only because supply in the services sector was constricted. Let's see. TLT didn't react much the next morning of the debate. I read somewhere, and possibly attribute the sell-off to Japan. Seems like Japan was dumping treasuries, given the yen destabilized, given no intervention. Given the yen destabilized, given no intervention, and given, that's a lot of givens. The way I understand it is Japanese investors sell treasuries due to higher yield prospect. I'm having a hard time seeing that. No. Let's just think about what we're saying here. What you're saying is that they're willingly buying something that they anticipate a price drop in. So if you have low interest rates, low Japanese interest rates, you're going to have very high prices on the bonds. And if you have high interest rates, you're going to have low prices on the bonds. So there's the US and there is Japan. So what you're saying is that they're selling US treasuries at low prices to buy Japanese bonds at high prices because they think interest rates are going to go up. If interest rates go up, that means prices go down. If you believe that rates are going to go down here, prices would go up. It would seem to me that you'd want to be in US bonds, not sell US bonds and get into Japanese bonds, unless your strategy was to willingly lose money. Then yes, that's what you should do. No, given interest rate differential, shouldn't yen strengthen? Yeah, the yen should strengthen. Understand that their inflation print was higher. Don't know how much it would also offset. Also, given Fed is expected to cut and short end bull steepening, short end gradually should. I'm having trouble unwrapping what you're saying here. Short end bull steepening, the short end of the curve steepening the long. Okay, gradually shouldn't low hedging FX swap hedging short end bull steepening gradually shouldn't low hedging FX swap hedging I don't know what the hell you're trying to say there. Incentive Japanese investors to hold treasuries instead of selling them. Well, yeah. Unless you expect the Japanese yen to really gain value, then there'd be no risk in holding the U.S. Treasury. You're getting, you're playing a carry trade. The risk to the carry trade is a strengthening yen. I don't know what's going on there, really. What do you think? Could you explain the Japanese plus Treasury plus yen dynamic? Also, how much do you attribute that sell-off to that? Yeah, these are questions that if you knew the answers to, you'd be golden. Nobody really knows. Was it the Japanese central bank selling treasuries and stockpiling U.S. dollars so that they could intervene at 163, 164, 165 without having to sell first? Could it be that? It could. Could it have been initial reaction from the debate and the Trump trade, thinking, oh, well, regardless of who wins, the deficit and the debt are just going to keep going up and up and up, and it's going to get unaffordable until somebody somewhere says, well, Trump is going to win, and he wants lower interest rates and a lower dollar. Oh, yeah, that's right. Could it be that? Could it be a bunch of things? Sure. I don't know that any move, I don't know that I would say it's one thing in particular. There is, I think, a growing consensus that U.S. debt, while not in a stress condition, will end in a stress condition, because there is no discussion of it. There is no recognition that it's a problem. But other people are recognizing, when you're paying $1 trillion a year in interest costs, and you're adding $1 trillion to the debt every 100 days, and no one who is responsible for it sees that as a problem. It's a problem, so it will end in a stress situation. So I think there's a growing narrative around that. However, I've said, to counter that for as long as you can, you got to run to the zero line, and combine that with Trump that wants lower interest rates. You're going to get lower interest rates in the short term, but we're not in a stress situation in the short term. So I think the place to be is in U.S. bonds right now. But a differential, a lower differential, two things will help the yen, right? The problem I see here is not the interest rate differential; it's the value of the U.S. dollar. And Trump wants a lower U.S. dollar, so you start getting a lower U.S. dollar. Well, those U.S. dollars will convert into fewer and fewer yen. So while you may get a yield differential you like, you're going to lose it on the dollar. If you start thinking the interest rate differential, IJPY minus IUSD, will get smaller and smaller, and you think the US dollar is going to drop, this will support the yen. This will support the yen twice as much, right? So you certainly don't want to be in US dollars if you think that is going to be the end game. I think that's a more likely outcome. Still have a bit of confusion about ABR. Could you please explain how ABR's loan portfolio serves as a pipeline to support its agency business? So you have this multifamily property over here that I've lent you money on, and it's 3 years, and it's interest only, and then you'll have a principal payment at the very end. The hope is that you can get this building into a condition that has the fundamentals, such that you can go right to agency and get a commercial or have it included in a CMBS, and you can move right into an agency mortgage, which means that I can give you a mortgage on this and I can sell it right to the agency. Do you get that? So after 3 years, we look at the value of this and we say, you know what, this qualifies for agency. So what I'm going to do is I'm going to give you a mortgage on this, and then we are going to sell this mortgage to the agency. And because I sold it to the agency, I then service the mortgage over time. So that is the hope. My understanding is they primarily deal in bridge loans, which are collateralized to CLO. So I did put a video up for a short defense. It's on YouTube, a short defense of ABR, and in that video I describe the whole process. So I would direct you to that one. Wondering what your thoughts on Nike are after the recent significant sell-off in earnings. Well, I think they have a management issue. I think it's time for new leadership. So until they announce a new CEO, or that the CEO is leaving, I think they'll be under pressure for a while. Recently listened to a podcast series where in each episode they would interview a different fund manager. Premise of the series was to ask them, how do you invest your own retirement portfolio? It was surprising to hear that all of them followed an all-weather approach. Few diversified and uncorrelated buckets, periodical rebalancing, and that's it. Nothing fancy, no options, no active trading, no macro, no fluff. It is funny that most sophisticated traders choose to ride beta with their money as opposed to seeking alpha. So think about it this way. You work for GM. in your retirement portfolio, would you hold GM stock? Probably not, because your income is already tied to GM. You don't want your investments correlated to what your income is tied to. This was the problem with Enron. People who worked for Enron and the Enron pension fund held a lot of Enron stock because management kept promoting that you should hold nothing but Enron stock. When the company failed, you lost both your investment and your job at the same time. So if I'm a manager with a particular strategy, and I have my retirement account over here, I want it uncorrelated with the strategy that I currently have, because if my strategy fails, I don't want everything to fail. That is why I have external money managers for a significant part of what I have, because if my strategy or my style has a bad year, I don't want everything I have to have a bad year. And my RSPs and TFSAs really are buy and hold. I own stuff in there that's it. I just own, and period. I really don't even think about it on a day-to-day basis. Could you explain why we use a constant cost of capital and a discounted cash flow instead of using higher rates for cash flows that are further out? Why would we? This is not a. We wouldn't use a spot curve for this. We're not the government. We are a company that actively manages its debt and its equity, which has a debt equity ratio, and actively manages that. We don't manage it with. Most companies have, a certain maturity structure that they target, an average maturity, an average duration, and it is a weighting of your debt and your after-tax cost of debt and your cost of equity. It should be fairly constant from year to year. A company is not a portfolio of 30-day, 60-day, 90-day, 4-month, 6-month, 1-year, 2-year, 3-year cash flows. It is, I shouldn't say cash flows, or isn't a portfolio of securities. If you think about a company, it is a perpetual, the company as a whole is a perpetual security. So I don't know that that you would use anything more than whatever the cost of capital of that company is. How much does it cost that company to generate that capital? That cost usually should be fairly constant. For the economic reports section, can we get the retails report? I was wondering which reports are coming next. I don't know. I put the important ones up that seem to be the focus of the Fed right now. Jobs report is a big one, and inflation numbers, PPI, CPI, they're big ones. So I put those up. Retail sales isn't really a big one. What would be a big, this is a bigger one now. GDP would probably be a bigger one to do than retail sales. I don't know what the next one is. You mentioned in the energy sector that EOR is doing wonders for oil companies. And to go back to the incomplete well and get huge free cash flow increase, do you think this trend will continue for the next decade, or new drillings are needed to provide the next? I've heard it given both ways. One energy industry association says the world will be awash with oil by 2030. There'll be so much oil. And another one says unless there's some new drilling, we are going to have a significant shortage of oil by 2030. I don't know. That's that is a tough one. I think it would be hard to convince companies to invest in new exploration, with everything that's going on in the world in terms of transitioning away from fossil-based fuels. Even if we don't go full EV and we go hybrid, that is still going to reduce the demand for oil. And I think in the automotive space, there will be probably on a going forward basis lower demand for oil over the next 10 years than higher demand for oil. So I don't know that I would bet a lot of money on companies that generate revenue by wildcat drilling. Right? I don't know that I would bet a lot of money on them. Any stock scanner filters that you can set that will tell you which stocks are trading at the bottom of a channel? I don't know. You mean like a technical screener? That would be a technical screener. No, I don't know. Would it be easy to add the transcripts to your CFA videos? Yes and no. I study your CFA material regarding reading the PDF, so when there's something I don't know, I take a look at the CFA readings. If I still can't quite get it, I go watch the videos. My thinking is it'd be convenient to have transcripts on the side. The problem with that is the translator isn't that great, especially when it comes to more technical terms. Number two, if you do have transcripts and you want to put them somewhere, you have to have a way to combine the transcript with the video so that the transcript scrolls with the video. That's a lot of work to do. That is a huge amount of work to do. To the point that the prices would have to go up significantly just to cover that cost. And I think it might be useful for less than 10% of the population. So if it were me, I'm not in charge of that anymore. I don't make those decisions. But if it were me, it would just be a no. No, I don't think so. Thinking about going long, the peso should hit 18.5 given the trade balance. And my belief that the U.S. is more likely to cut in July than what is being priced in. Yeah, I think the peso makes sense. Not only did we get the positive trade information, if you look at the level of investment, fixed investment, that was reported this week, came in way above expectations. Why does this video pop up first in YouTube and later on your site? Well, I got to put it on YouTube first before it goes anywhere else. So I put it on YouTube, and then IT takes it off of YouTube and brings it over to Amazon, or I think maybe just feeds it through a YouTube feeder. I don't really know, but it must go up on YouTube first. I put it up on Sunday. Sunday nobody works, right? So usually it's posted Monday. Nobody works on Sunday. And the day you're pointing out, July 1st, that's a Canadian holiday. The IT team that's responsible for this is in Canada. CPI data coming so hot. Why did it not have a significant impact on REITs like Capri? I don't know. I found that curious. When I saw the inflation data at 8:30, I thought, this is going to open lower. So how much am I going to buy? They'll all open lower, and being that it's CPI, it's probably going to hang out for a couple of weeks, and it didn't give much of an opportunity at all. So it could be that there is a growing recognition that it really doesn't matter. These things have a numerator and a denominator, and immigration to Canada is far exceeding the ability of housing to keep pace. Where are they going to go? They got to rent. Where are they going to go? And that's your numerator. Why yields would rise because of irresponsible fiscal spending? Well, think about it this way. You are irresponsible with your money. And you keep getting new credit cards and spending more and new credit cards and spending more, and your debt is rising, and you come to me for a loan. You're super risky. Either I'm going to say no, or I want 30% interest, 35% interest, 40% interest, because there's a high probability you'll default. That's what it is. Is it because the long end of the curve incorporates inflation expectation? No. We can bypass all of that. It's just what I explained to you. Regarding last Friday's Treasury sell-off, rather counterintuitive to the latest PCE report, you put forward one possibility is the realization of the next administration's ignorance of the national debt, having a hard time following the argument because the bond market usually behaves rationally, and the growth trajectory of the deficit should have been priced in long before the debate. Anything else you can think of a possible cause? It could just be the whim of the market. Yeah, well, that's just it. Could just be, the market doesn't I have found doesn't look at the whole story. It looks at the proximate story, and it doesn't really think more than one move ahead. It just thinks about the next move. But if you play the game out, you can see that there are certain outcomes. When you think about the debt, it is big, and it is only going to get bigger regardless of who wins. It's only going to get bigger, and as interest rates stay where they are, it's only going to get worse. So you can start with that like this is not going to work out well. Nobody talked about the deficit. Nobody talked about the debt. This is a problem. And then you start thinking, yeah, but Trump's going to win, and Trump wants a lower U.S. dollar and lower interest rates. So who cares about the debt? The debt is far more affordable if interest rates are zero. If you bring those rates back to the zero line, you can keep issuing money market securities, 3-month and 6-month T-bills, and pay almost nothing. You basically getting free money at that point. You're borrowing for free at that point. Trump wants lower rates. He's going to get them. Powell will give it to him, or Powell will be gone and somebody else will give it to him, but he's going to get what he wants. How would you do it if you have to start from the beginning? When it comes to specializing yourself in one industry, for example, the energy sector, well, you start with one company. You grab their 10K. You look at their 10Qs. You listen to their conference calls. Then you grab a second company. Then you, watch what other people say about it. Maybe there are other more advanced people on Seeking Alpha or somewhere that have something to say that you read a bit. You go, okay, well, this is new information. This is new information, even though I don't agree with this and this. And little by little, even somebody who has nothing to say may have a data source you've never heard of before. There's always value in that. Maybe you go to the data source and you say, well, this is a good data source, although what you have to say is idiotic. You just start. You simply just start. There is no chapter 1. You just jump in and you start working from there. And you follow whatever pathway that it brings you on. Sometimes you'll spend a couple of days pursuing a pathway that is of no value. But it always has some value in that you'll learn something. It may not be on point of what you need, but you'll learn something, and that pathway may lead to another data source, which leads to something else. You simply just start. Sold some 14 calls on ABR last month, ended up with a short position I'm okay with. I'm comfortable being short for a bit as I expect them to drop to or below their book value. Historically, does their share issuance generally move the price much? Well, they have a shelf registration, an at the market, so they don't have to announce if they're selling shares. They could just be selling shares. We won't know until their earnings. I don't know that I'd want to be short ABR in shares simply because you're paying 6.5% on the borrow. It's not free to be short ABR shares. You are paying to be short. I would have rolled the call over. It seems as though LSEG doesn't always update this week in earnings newsletter. Latest I see is June 3rd on their website. Always use the link in the description box. I put the latest one up there. In one of your past videos, you mentioned that you are going to hire analysts who will cover specific market segments. Will you organize an office space for them and they work from home? Depends on where they are. It is difficult to find the skill set that you need all in one city. And being that I split my time between Costa Rica and Canada, it would be, I think, what's the word I'm looking for here? Be ridiculous. Let's just use that word, to think that they would spend their time in the two countries as well. So for what I'm thinking about for the analysts, it would be work from wherever you are, because their income would be tied to their output, not tied to hours per week, but tied to their output, which means no output, no income. I think at that point you can work from anywhere you want, because it's not as if you're getting a full-time paycheck for part-time hours. You are, responsible for your own income at that point. I shouldn't say responsible for it, but you are in control of it. Curious to get your ideas, or your views on the idea of wealth in today's world versus the past. Seems like we focus so much attention on net worth and assets as a proxy for wealth, versus a more ancient view that wealth is not so much about one's personal assets, but enriching your friends and knowing that their assets, so to speak, are a proxy of your wealth. But then wouldn't they be doing that to us, knowing that our assets are a proxy for their wealth? And if everyone's doing that for everyone else, how do we know what's in the best interests of everyone else? Wouldn't we over time say, listen, why don't you do you and I'll do me? I mean, why am I looking after your backyard and you're looking after my backyard? I'll mow my lawn, you mow your lawn. How's that sound? Because I know what I want. I want it done a certain way. That if everybody starts paying attention to their own self-interest, wouldn't that be better, rather than being your brother's keeper all the time? I'm thinking in the context of Xenophon. More broadly, it seems like in today's world, one needs to protect their wealth via insurance, underpaying taxes, rule of law. Another aspect is support structures and family, which is a form of wealth. Seems less prevalent for many people today. In fact, I would argue there's huge carry just to feel comfortable in your wealth, that it wouldn't be taken away in the form of extra insurance to protect your assets and in cases where the other party is not insured. I don't understand any of that. I don't understand the second part of what you're getting at there. So how you measure what's important to you in life is going to be different than the person beside you. What you have to ask yourself is, do you want to determine what's important to you, or do you want your neighbor to determine what's important to you? Or do you want your government to determine what's important for you? Right? If your government decides that community is more important, that looking after everyone else is more important, that what you should do is, if you have an excess of anything, the state should take it from you and give it to those who have a deficit of it. Do you find that would be a source of a definition of wealth, where your wealth is the good feeling you get from being your brother's keeper? and that you are more than happy to work for the benefit of other people. Maybe that's what you want. And there are countries you can go to where the effort of what you put forth will be shared widely with everyone. Or do you want to determine what's right for you? Maybe you don't measure wealth with monetary assets. Maybe you measure it with relationships. Well, then you do you. Other people measure it a different way. But just because somebody measures wealth with monetary value doesn't mean they don't value relationships. They just see it as another form of wealth that it matters more than the actual asset value. I don't see them as being that it's one or the other. Why is it not all of it, right? Do you recall what the effects were after the wage price controls by Nixon in '71? No, I was just a kid. Did it cause more inflation after the night? I don't know. I don't recall. Could you kindly elaborate on the mechanism concerning market players hedging away risks from fiscal deficit, inflation, and rates? Well, I don't know if you can hedge away from fiscal deficits. What tools are available to investors today that were not available 10, 20 years ago that now make them immune to these changes and that make monetary policy less effective? Oh, geez. I mean, how long have you got? You simply just have to go to Chicago Board of Trade, or SIBO, and just do a search on new derivative securities since 2005. Even in the interest rate swap market, the move from OTC to counterparties has dramatically increased the size of that market, such that it is not something you would see on selected balance sheets that you saw interest rate swaps. Now it's almost common that every company that has debt has interest rate swaps. Just the amount of products available for the consumer and how the consumer can protect themselves, and the access to investments they have today that they never had before. Products that are structured for inflation hedging, that are structured for interest rate hedging, that are now available more widely than they've ever been available. You don't have to go through a dealer in OTC. A lot of that stuff is being brought onto exchanges by as much as it possibly can. That would be a long conversation to have. Even in just the new tools, just the new securities and the new derivatives that have been introduced over time. Do you ever watch hockey? Not really. Not really. You have said a number of times Canadian residential REITs is your highest conviction trade. Yep. Wondering, do you have the same level of conviction about U.S. residential REITs? No, just Canadian. Not that I'm negative on U.S. Residential REITs. Just if I had to pick one, it would be Canadian REITs all day long. Would be interested to hear Tesla risk reversals are following production and delivery beat. Any changes? Yeah, they beat. They shrunk year over year, but not as much as what was anticipated. But still a shrinking company still. And they're up $45 in 1 week, 33% increase. I think the last I saw they were $245 up from $180, $260, a 33% increase in a week on a shrinking company. And a lot of it based on imaginary products and imaginary revenue streams that don't exist. One thing that I've come clearly to see is it does not matter what the financial statements of Tesla are. In fact, it could suspend all financial statements from here on in, and I don't think it would have an effect on its price. It's not a company trade, it's a shareholder trade. You're trading the shareholder because the shareholder is a flock. It's not like most other companies which have a significant institutional presence. This has a significant retail presence, and it's You have to play the retail trader, which means you tell them what they want to hear, and don't hold back. Don't say the stock, that we have we see 20% upside. No, you got to say we see 20 times upside. Don't hold back. Talk about flying cars in 2025. Talk about 1 billion robots by 2025 in households, fully programmable. Talk about a robo-taxi, that's just around the corner and full self-driving. And keep pumping that. Keep pumping that. 8 trillion, no, 30 trillion. You gotta go really crazy on this. It is a play on the shareholder. GM had great numbers, beat expectations. EV sales grew by 40%. By all measures, GM is firing on all cylinders. On the price. Trading at less than 5 times forward earnings. Tesla's what are we pushing up now? Over 100 times forward earnings, and going up on imaginary products that simply don't exist at this point in time, and a car company that's actually shrinking, not growing but shrinking, and is worth 20 times what GM is worth. That is not an efficient price. That is not a logical market. Waymo already has a robotaxi. GM already has a robotaxi. GM had problems with Cruise, but Cruise is back on the road generating revenue. Even if it generates $1 today, that's an infinite percentage more than what Tesla is generating. Tesla has no robotaxi at this point in time. Have you seen the latest video of the robotaxi, of the robotaxi mock-up? Have you seen it? It's a cardboard box. I kid you not. It's a cardboard box. It's a fucking cardboard box. And this is where they're going. So what I did, I recognized that this is a fight I'm not going to win. So pre-market, it had gone up over 220. It came back down to around the 219, the 218, 219 level. I looked at the delta that I had, and I got delta neutral. And by the end of the day, it got to 228, and I closed the position. So I made here, lost here. Overall, I lost about $4,000 on the whole thing after getting delta neutral. Lost $4,000, and that's it. I'm absolutely right on the fundamentals of Tesla. It is at this point in time, I think, what BlackBerry was in 2008, and I think it will follow that path. It has competition from everywhere, and to think that by the time Tesla introduces a robotaxi platform, you know who is going to be the big winner in this? Uber. If there is robotaxis, it'll be Uber, or any of the companies that are already out there. And in China, how many are out there? How many, robotaxi companies are already out there that by the time Tesla shows up, it'll be such a crowded industry. Now you may argue, well, but all the people who own Tesla vehicles, they'll all turn into robotaxis, and the idea that they'll all make 30,000. Not if everyone does it. Not in 2 or 3 years or 4 years or 5 years. First of all, the idea that an individual car owner will be able to do that is pure fantasy from a regulatory perspective at this point. And that is at least a decade away. Period. Because you're not even going to get insurance on that. So that's not even in there, but it's in the price, right? All you have to do is tell the Tesla shareholder about this wonderful fantasy future, and they will take it as absolutely gonna happen. This is an $8 trillion company. It just happens to only be trading for 900 billion. What are we doing? You can't short that, right? I'm gonna be right on the fundamentals, but I'm gonna be wrong on the price because I'm trading the wrong thing. I'm trading the financial statements. I'm not trading the fantasy. If I were trading the fantasy, I would be 100% long Tesla. And I'd be putting out video after video after video with my credentials saying, I have done a detailed deep dive on this. I can't believe I was so wrong. Oh my God, this thing is worth this much today. I have everything I have in this thing. And if I put that out, my audience would swell. It would be unbelievable how many viewers I would have. It would be the most viewed video. It would have 100,000 views in a week because I am telling people exactly what they want to hear. I'll be called a genius. I'll be called an incredible investor. I'll be called every wonderful name in the book. But I won't believe a single word I'm saying, but I will believe that I'm trading the shareholder and I'm not trading the company anymore. If you're investing in Tesla, you're investing in the shareholder and the gullibility of the shareholder. You're not investing in the financial statements. The financial statements will not work out anywhere near what the fantasy is. But you'll go broke trying to short this, trying to short it on a fundamental play. This is a psychological stock. This is a cult stock. It's a religious stock. You cannot short this. So my savings grace is that my position was small and I had the ability to hedge out and then just take a small loss. Thinking about your argument on recent videos of technology and AI being deflationary, which I agree has been the case for most of recent history. However, with today's trend of dynamic pricing, yield management that is fueled by AI, even grocery stores are now adopting it. Aren't we in a completely reverse situation? Technology now allows prices to be an average higher and sales to increase. This is true. You can say that, there is a side to AI which allows a dynamic skimming of the market. Skimming of the market typically meant that you would put out a product at a high price, and you'd get whatever customers you can get at that price, and then you'd just lower the price. In other words, you would skim the market, right? Well, now you can have dynamic skimming the market, which means you don't have to wait over time as you put a product out, and depending on your customer, rather than set a price and see which customers you get, you do it the other way around. You see which customer you get, and then you set the price for them. So that it is possible 50 people can get 50 different prices depending on what you think their ability to pay is, and maximize your revenue that way. So it could be inflationary in that sense, that when you're measuring the cost, and it is interesting to think about that if you are measuring the price of things, whose price are you measuring? That if you're the CPI and you're going into a place and looking at the price on the shelf, I guess it would have to be a posted price on the shelf. But what about airline tickets where there are no posted price? Your CPI, you're going to look for that. How do you know the price that you're getting is close to the average price? How do you know that the price you're getting isn't set for you? That is interesting. It must affect methodology somewhere, right? So that when you, I know when I go into Home Depot and I see a price on a shelf, I know that's the price that everyone pays, that price on the shelf. If I go to Amazon and order it, I don't know any longer if my price is higher than your price, because there is no price on a shelf that we can all look at. The price is served to me based on what the algorithm thinks that I'm willing to pay. Whereas with Home Depot, the price is listed on the shelf. That is a good question. I don't know the answer to that, but it is something to noodle around with, to start thinking about how would that affect the methodology of collecting prices. Could sustained inflation we're going through be a result of the whole market transitioning to fully dynamic pricing? Well, the whole market isn't transitioning to that. Like I say, for most retail stores that you enter, there's a price that's listed there that the next person coming along could be a minimum wage employee or a billionaire. They will see the same price. It's the same price for both those people. But if they're on Amazon, I guarantee you they will have two very different prices. If they're ordering a seat on Air Canada, I guarantee you they will have two very different prices depending on how much the algorithm knows about that person. The extent to which prices have to be looked up online, you could say, might be skewing the inflationary numbers. Might be. Yeah, I can accept that there is something. If I were collecting samples, it would be something that I would have to say, is this a problem? Is this one of the threats to our validity? Is that we might not be getting representative pricing. And if that's the case, then I may have to say we can only accept prices that have a listed price, a clearly listed price that everybody sees, but cannot have a dynamic price. Can you please share? Oh, that's Tesla already did that. Given what you mentioned about the debt issue in the U.S., you said you currently not adding to your TLT position, but are looking to reduce your exposure to TLT. When I recall, you have a sizable position. My position in TLT, what I've done over time is I've transitioned it to the actual bonds because I can get a higher yield out of that and a slightly better duration statistic. Better meaning higher. Do you invest in anything other than stocks, artworks, properties, watches, wines? I'm not. I'm not materialistic. I mean, I have functional things. I have things that I enjoy using, but just to have things hanging around, I not really. I don't drink, so I don't collect wines. I don't know enough about them. Watches, I don't see the point of. I don't like them. I don't understand them. I wouldn't know what to buy. Properties, well, I have two, but it's not like I'm collecting properties because I think they're good investments. Artwork, yeah, I'm slowly starting to get more interested in that, but not really. Not really. You don't make a point of technical analysis. But how do you think about those quantitative funds which really don't care about the fundamentals at all? Most successfully with Renaissance technology. I don't know that I don't know that I would say they don't care about fundamentals. Quantitative approach doesn't mean that you're technical. I mean, you could be, but it doesn't mean that you are. You could have a fundamental approach, or sorry, a quantitative approach that relies on fundamentals. It's just that you're doing it purely quantitatively as opposed to any kind of subjective evaluation of the numbers. You're just looking at relationships among companies based on return on equity, return on invested capital, return on that. A quantitative approach does not mean no fundamentals. I wonder if you can help me understand your thesis on why the Fed has to cut rates. Here's my current understanding: Fed has two official mandates: price stability, maximum. Well, very simple. I don't have to read what your position is if you want to understand why I think they have to cut rates. The cost of the debt is going to get too high. It's going to affect growth at some point. I think that they're on a Japan trajectory, and they are going to have to cut rates. They are going to have to go to the zero line. They'll have no choice. That the gravity of the debt will crush them. Number two, Trump wants it. I mean, that's the bigger one right there. Trump wants it. Period. End of story. Powell will either give it to him or Powell will look for another job. Period. That's it. CFA level 3 in August. Do you recommend reviewing your mock exams now until they are completed, then review weak areas until exam day? Sure. Wait until closer to exam to review your mocks and review until then? Sure. Something else? Sure. I recommend whatever works for you. I've answered this question I don't know how many thousands of times, and I scratch my head and I wonder, you're at level 3. This is not your first dance. You've done this 2 times already. You've done level 1, you've done level 2, and you got a whole university career behind you that you are asking me at this point in time how to prepare for an exam. To me is shocking. You should do whatever has made you successful in the past. However you've prepared for exams in the past, that's what you should do. There is no one right way to do it. So if you say, here's my plan, what do you think? I would say, yeah, if it's your plan, you would have written it up in a way that you thought was right for you. So whatever plan you come up with, I would say, yeah, you'd never come up with a really wild plan that you'd never do on your own and say, what do you think? So whatever plan you come up with, I think, well, you must have thought it through. This must be right for you, so yes. Whatever plan you give me, yes. This is not your first dance. You shouldn't be having these questions. Okay, what do we got here? Amazon's now trading at 200. I have Amazon 205, January 2026. 2026? Wow, you really went out. Is up. That is plus 65%. Should I roll over? Roll over? Roll over? You're 18 months away. You're in no danger of this thing sneaking up on you. Roll over for what? Roll over to where? If so, at what strike? That beats the hell out of me. I don't know what. Why roll over to what? When you originally bought it, it had a delta. Let's say it had a delta of 0.4. Look at the delta now. What's the delta on it? Let's say it's 0.48. And you say, I always want it to stay at 0.4. Well, then you would close this one out and you would roll up to a delta that has 0.4. But why? I don't understand why you bought it. If you roll it over now, all you do is you bring that capital gain into this taxable year. This is January 2026. If you let it run, you won't have to pay tax on this thing till 2026. So if your tax rate's 40%, you're going to lose 40% of your gain just by taking it now. I could see if you had July options that are up 65%. Yeah, take your profit. Why take the risk? But January 2026, and you're thinking about rolling over 18 months out. You're paying too much attention to the option. Pay attention to Amazon. Amazon's at 200. In 18 months, is it going to be more than 200? If your answer is yes, then hold it. Then keep holding. Reading Intelligent Investor, again, one of the primary recommendations is limit yourself to issues that are selling not far above their tangible asset value. GM's current tangible book value per share is at $56.50. Tangible book value per share, $56.50. That might be a little high. Actually, no, it wouldn't be, right? Because they did a whole bunch of share buybacks. Yeah, that's right. So it could be, yeah. Trading at $26.80 at the end of last year. Yeah, but at the end of last year, I think their tangible book value per share was somewhere around 38. Do union negotiations always prove to be? I would not say it was union negotiations that. I see what you mean. The union negotiations drive down the price. For this time it did, because they had great success with UPS, and the UAW leader was talking about, all-out warfare and wanted record contracts. So the belief was that they were going to be very militant on this one. So yeah, it did have something to do with pushing down the price. Do you use big data analysis? No. How'd you go about finding hard evidence of personalized pricing occurring at a large scale? Amazon, Air Canada. There you go. Just those two alone. Or are you comfortable making investment decisions based on your own anecdotal experience? Well, I'm not shorting any of these companies. If there was a way to short that strategy, I would think about it, most definitely. It's not going to be long before before you hear your elected officials talking about the crime of this thing, however they want to classify it as a crime. It's not going to be long before there'll be some legislation not legislating dynamic pricing, but legislating the use of a person's private data in determining their price. And if you can't use my private data, you don't know anything about me. You can't figure out what my price is, right? So I think, I have no problem with dynamic pricing during the course of the day. Listen, we're busiest from 10 to 12, so it'll cost more between 10 to 12. Well, that's fine. But hey, you're a successful person. It's going to cost you more than anybody else. I got a big problem with that. You don't get to do well based on my effort, on my success. Sorry, it won't be long before that's going to become an issue. Mark my words. Researching a drug development company to try and decide if I want to buy their stock. Found myself reading highly specific peer-reviewed medical research papers. Yeah, that is, unless you have a background in that, you're not going to understand most of what you're reading. That's why I pretty much ignore biotech companies altogether, because I wouldn't understand what I was investing in. Even if you told me what it was and you told me, oh, this reacts with this and this does that, I'd be like, I don't even understand this. So I just avoid all of that altogether. Curious how you would approach making educational videos for highly technical sub-industries. I would avoid the technicalities. I would avoid as much of that as possible. And for some, like biotech, there's really not a lot that I can do there on any one company. I mean, I can talk about broad fields that where research is going on, but I wouldn't have a clue. You give me 10 companies, say which one's the winner. I don't know. Flip a coin, flip 10 coins. I mean, I don't know. Yeah, there are some things I know nothing about, and for me to learn it wouldn't be worth the time it would take to get to the level of sophistication to understand exactly what they're doing. For what it is that they are doing, it's, well, what is the market that they're addressing? What is the size of that market? What other things do they have going on? Is this a small company putting everything into one basket? How have they done on phase 1, phase 2? Are they in phase 3? What are the early results out of that? I mean, what does that mean? That's all I can tell you. Assessing the value of their drug in terms of its potential to actually be approved, not a clue. Not a clue. Have you actually been in a Tesla with full self-driving? Nope. It's actually quite good. Maybe it is. I agree, robotaxi won't happen on 8.8, but 10 years seems way too far. Well, if we're thinking about coast-to-coast robotaxis where my car will just leave my driveway at night and I'll see it go pick up a ride, yeah, 10 years. I'd say even 20 years. I'd say even 30 years for something like that to happen, if it ever does happen at all. I think that is pure fantasy. There are already robotaxis out there. Google's Waymo is doing 50,000 rides a week, paid rides a week, 50,000. Cruise is back on the road doing rides again. And there are dozens of robotaxi companies around the world. Dozens. It's not as if this is not happening. It is already happening. Tesla, zero. Do they have a robotaxi? No. They're trying to do coast to coast. They want to do the big leap all the way to coast. Everyone will have already crowded the market before they get there. It's the wrong strategy. It's a BlackBerry strategy. It's this long cycle strategy, and they're missing all of the fast cycles that are happening right below them. They don't even have an application anywhere for a regulator to operate even a robo-taxi in a geofenced area. They're too proud for that. No, it's going to be everything. Either they're too proud or they know that this is not going to happen. But why tell the shareholder? Why tell the shareholder? Why tell them? Why not make a big pile of money off this right now? I don't know if that's what's going on. But if you say, well, if you've never driven a full self-driving, you've never driven Tesla, well, have you driven in a Waymo? Drive in a Waymo. If I blindfolded you and put you in a Waymo and I drove you around, I said, what car are you in? You probably wouldn't know the difference. If I put you in a Cruise and I drove you around, I said, what car are you in? You probably wouldn't know the difference. If I put you in a Zoox or any of the 20 to 30 robo-taxi businesses that are in the world, you probably wouldn't know the difference. If I put you in a Mercedes that had self-driving, and blindfolded you, you probably wouldn't know the difference either. There is this other belief among Tesla fans that this future will be a Tesla-only future. It will be a barely Tesla future. They're already way behind in the robotaxi business, in the robotaxi space. And as far as a platform, Uber will be the platform. Uber will win. If there is a coast-to-coast network that this is allowed coast-to-coast, Uber will be the winner. Hands down. Uber will be the winner. not Tesla. No, this is all fantasy. I don't need to drive a Tesla with full self-driving, right? I don't need to do that. Much as you don't need to own an iPhone to know that Apple is winning on a lot of fronts. You don't need to own an Apple computer to know that Apple is winning there as well. You don't need to own an Apple Watch to know that it's selling. You don't need to know. You don't need to own these things to know that, right? You don't need You didn't need to own a BlackBerry to know that it was dying. This idea that unless you try it, you don't know. I would say to everybody who says, have you ever tried a Tesla with full self-driving? I would say, have you ever tried a Waymo? Blindfold yourself and let somebody put you in one of two vehicles, and then you try to figure out which one you were in after. You're not going to know the difference. The difference between these things are probably going to be minimal. Yeah. Would it be wise for an institutional investor to scale your put selling strategy instead of simply using limit orders to buy stocks? Yeah, if you're putting a limit order in and you don't get it, you got paid nothing for that. Why not sell some puts? Why not sell puts? If you don't get your limit order filled, you at least made some money on the puts, right? And if you do get it filled, you get to keep all the money from the puts. You get it at a lower price. You win no matter what. Also speak on the new vehicle sales growth rate between GM and Toyota. Yeah, Toyota is quickly approaching GM. Yeah, they're in a fight for number one. Toyota did displace them for 1 quarter, but then GM got it back. But I do prefer GM, yeah. Why does SOFR tend to spike during quarter ends? I don't know. I don't know that I paid attention to SOFR spiking during quarter ends. I saw it hit 5.4. Well, that is, I don't know that I would say that that's quarter end. That's something else going on. SOFR rates hitting those high levels. There's something else going on. Repos and reverse repos tend to spike quarter end. Do you think the TLT sell-off is the wrong move? Yep, I do. Because Trump's going to win. With the information we have right now, Biden's not going anywhere, okay? Trump's going to win. Trump wants lower rates, period. End of story. I agree with the outlook on U.S. debt, but I can't see it imploding for another decade. Yeah, we're not at stress levels. We're on our way to stress levels, and nothing, I don't think, is going to change that. On the other hand, we can see the interest rates will be cut, likely be cut faster. The Fed wants to take matters in their own hands. Why is this not bullish for long-term bonds and underlying like TLT? The market just has to come to that conclusion. Where will people go if not the U.S. bond market? Correct? Do you foresee yields going higher, staying for some reason? Nope. Market is priced for quite a bit. Well, there's little move in long-term bonds. I find it hard to believe that they won't move to diversify into safer assets. The market is priced for quite a bit. Well, there's little love for longer-term bonds. I find it hard to believe that they won't move. I'm not sure who the they is there. They won't move. They meaning the Fed, or they meaning the market? They won't move to diversify into safer assets. That must be the market. Give it a 2-year time horizon. Why could holding TLT or other long-term bonds not be a high return, lower risk strategy? I think it is now a Trump. You could put it firmly in the Trump trade camp. One of the annoying aspects of trading U.S. options while living in Canada is that you have to record the exchange rate on every transaction for tax purposes. No, you don't. You don't have to do that. Do you rely on IB to do that for you? They do that for you. But you have a spreadsheet for this. IB gives you the spreadsheet for it. It's called the FX worksheet. They give you that. They give you that, and that is incorporated into the statements, all the tax forms that you get. You have all of that. Yeah, that's all given to you. What are your thoughts on high frequency trading? Are there opportunities for us in that space? I think you got to go big. I think you need very sophisticated hardware. you need to understand where in the warehouse or where in the data house you're going to be. And I think it's a big guy's game. It's not for the retail investor. You don't have the computing power nor the internet connection to get it done at all. At all. You need to be co-located with the exchange on fiber, as close to the data source as you possibly can be, closer than any other computer. You're going to pay for that. You are going to pay big money for that. And now that data has to get to you, so you're not sitting at home. You got to have the straightest fiber line possible. No, it's a big person's game. Big person's game. Passive small cap investor, S&P small cap, better pick than Russell if the fees are the same. Does the higher quality of S&P small cap make it fair to expect long-term outperformance over Russell? No, that on its own doesn't do anything. No, it just means that if you're in the 600, you're in profitable companies. As far as will it outperform the Russell, beats the hell out of me. The future is unknowable. Could, or it could not. That's about the best I can tell you. How are you managing your short risk reversal position? Already answered that. Do you use Freight Wave? Nope. Nope. Small investor with programming skills. What are the best financial instruments, strategies, and which market do you see is the best fit for arbitrage opportunities using algorithms? None of them. You are way too small. As soon as you said small, you got a computer, you got a few little programming tools. You are nowhere near in any position at all to grab arbitrage. All the market makers are way in front of you in the lineup. You're not going to grab anything at all. Do you think that having access to the depth of book quotes increases the space of opportunity? Nope. Chance for arbitrage? Not at all. I don't even use level 2. There'd be no point in using level 2. A lot of it is useless information. You think because you have more numbers on the screen, you have more information, but there's nothing there really. I've had level 2 before, and it's if with spoofing, you can't believe some of the numbers that you see. You could have a bid. Let's see, a bid and an ask. Let's see, you have something at 25.20 to 25, 24, and then you have a bunch of buys here and you have a bunch of sells here. And if I want to get the price down, what I can do is I can put 100,000 unit order here at 25.39. And if you have level 2, people will start to see this. This will slowly walk itself down, and then I've done my job. It may not be real. If I'm showing you my hand, it's because it's the hand I want you to see. It's not because it's real. It could be real, or it could just be the hand I want you to see. There's no information in this level 2 stuff. I wouldn't pay for them. U.S. debt situation, its implications on what one can do differently. I don't know that anyone can do anything differently there. Tesla again. If AI adoption starts to lose momentum, AI stocks be poised to suffer as much as work from home and play from home. Yeah, stocks did when the economy reopened. From what I recall, many were priced in for absolute perfection. Yeah, that is it on AI adoption. In 1999, everyone thought the internet build out was decades long, that this was going to go on for decades, and it went on for maybe, after 1999 was over, it went on for another 3 months before it all just fell apart, or it began falling apart, and people started to realize that, wait a minute, most of these companies are never going to go anywhere. You got a lot of companies rushing into the AI space. A lot of startups, a lot of money going into AI startups for this and for that and for this and for that and for this and for that. It was like the internet. It's like it's going to change everything. The internet did eventually change everything, and everyone had the feeling at the time it was going to change everything, but not in 1 year. I think it's the same with AI right now, is that you've had this nice breakthrough. You got a lot of people rushing into the space. I think the build out is going to be a long build out, but at a much lower, slower rate. I think you're very soon going to have potential overcapacity in the AI space, with the realization that a lot of these models that are being trained, it's not really doing much, is it? Not much more than what a regression model could have done. Its R squared isn't that much better, really. Maybe it has the same or even a lower adjusted R squared after you consider all the parameters. I don't know. Maybe just predictive analytics, something we've been doing for 50 years. Maybe that's pretty good. Maybe that's good enough. I don't know. But a lot of the models that are chasing spaces right now, I think will come up empty. And when that starts happening, when these startups start failing because there's nothing there, that may cascade a bit. And then suddenly you've got all of this server space available, right? And that was the internet in 1999, 2000. Once you got to 2000, like, hey, look at all these servers that are available. Look at all this space that's available, because a lot of these other companies just disappeared. Please provide a link to 440 US for non-CFA. Just go to markmeldrum.com and across the top, find the words applied level. Click on that and you'll find it. Contact an external manager. Be charged 1 to 1.25 annual fee. Total returns not beating the simple S&P 500. Oh, already answered that in the Sunday Night Live feed. Why does Kathy Wood's ARK investment vehicle still exist despite blowing up billions of dollars of investors' money? Yeah, that is a good question. It could be that there's a certain factor exposure that she gives you, right? You get the certain factor exposure, and it is not her responsibility to manage the return on that factor. It is your responsibility to manage your exposure to that factor. I mean, you could say the same thing when we got in 2015. Why does the USO, which is an ETF that tracks oil, exist? Why does the USO even exist? Because it went all the way down. I mean, it lost a lot of money for a lot of investors. Why does it even exist? Well, that's what it does. That's what it says it was going to do. It said it was going to track the price of oil. The price of oil went down. It's your responsibility to determine whether you want exposure to oil or not. So Kathy Wood explains that her ARK fund has exposure to a particular type of factor, which is these high growth speculative tech companies. And it is for you to decide how much of your portfolio you want to have that factor exposure to. The return on that factor exposure is out of her control. She's just going to give you the return of the factor exposure. The return's been negative for a long time. Well, that's what the factor exposure returned. So her argument is, I'm not destroying value. I am giving you access to a factor that you can't get on your own. It's not my fault the factor's not performing. Much as the USO, the sponsors of the USO ETF would say, it's not our fault price is dropping. You can't say, oh my God, this ETF's destroyed a lot of value. It shouldn't exist. That could be Kathy Wood's argument is, hey, look, this is just a factor exposure. I never claimed that my benchmark was the market. I never claimed that at all. My benchmark is this factor exposure. If this factor exposure is out of favor, nothing I can do about it, right? CMRE container ship suggestion. They're small though. They're too small. And very limited geographically. Regarding end of quarter, end of month reverse repo, this is common. Why window dressing is companies, because the end of June is a reporting period for balance sheets. an income statement. So what companies will do is they'll reduce the amount of repos they use to make it appear on their balance sheet that they have lower leverage than what they actually have, right? So it is very common to do a lot of that at the end of the month and at the end of a quarter, especially a reporting quarter, so that you can then lower your leverage. Even if it's only for one day, the balance sheet is a snapshot at a point in time. So even if it's for one day, ratios for leverage will be done based on those numbers. You can lower your repo usage for one day. It's not that much risk to do for one day, but it may keep you in certain, within certain ratios, that your leverage doesn't look that bad, that you had great numbers and you did it all with really low leverage. That's pretty impressive, right? It makes the numbers look a little bit better. Then the very next day you lever back up again. And that's it.